to break down the steps taken by the People's Bank of China and Chinese officials. What do the measures that have been taken for the economy mean, really? In a bold move, PBOC's governor, Gongsheng, announced a series of significant monetary policy changes aimed at revitalizing the Chinese economy. Firstly, interest rates have been cut. The 7-day reverse repurchase rate was reduced from 1.7% to 1.5%. This is the rate at which banks can actually park their excess liquidity with the central bank. And this move will motivate banks to lend out to the real economy for better returns. Additionally, the bank's required reserve ratio was lowered by 0.5 percentage points. This is the portion of money banks need to park with the central bank out of the total outlay for lending. And this move will release about 1 trillion yuan into the economy. And this is the lowest level since 2018 and aims to boost liquidity in the Chinese market. The central bank also introduced a comprehensive package to support the struggling property market. This includes lowering mortgage rates for around $5.3 trillion in existing mortgages and reducing payment requirements for second home buyers from 25% to just 15%. To stabilize the Chinese stock market, the central bank also plans to inject at least 800 billion yuan or approximately $113 billion in liquidity. Officials are even considering to create a market stabilization fund. While these measures may seem promising, challenges remain. Economic growth has slowed significantly, with recent data showing the worst pace in 5 quarters. Experts are questioning whether these actions will actually be enough to stimulate consumer spending and combat long-term issues like deflation. Despite these monetary easings, many analysts believe that more aggressive fiscal measures are needed, especially as local governments face declining revenues. The government's growth target of around 5% this year is under pressure, raising concerns about whether these monetary policy changes can restore consumer confidence and drive spending. And following the announcements, China's benchmark CSI 300 index surged by as much as 4%, a hopeful sign for investors. However, it's crucial to note that the index is still down more than 40% from its peak in the year 2021. So what does this mean for the average Chinese citizen? With lower interest rates and reduced mortgage costs, buying a home may become more accessible for some, but persistent job insecurity and falling property prices raising concerns about long-term financial stability. Consumer confidence is crucial. If people remain hesitant to spend due to fears of layoffs or falling incomes, these monetary measures might not achieve the desired impact. And to summarize this, while the PBOC's recent policy shifts aim to support the economy, the path to recovery is still fraught with uncertainty. For many, the question remains, will these changes be enough to improve daily life and create a sustainable economy? That only time will tell. To stay up to speed with the latest news, download the WION app and subscribe to our YouTube channel.